Hello, everyone. Welcome to the weekly roundup. Today we will cover interest rates, economic data, and market sentiments. Hello, Ben.
Hey, Eva.
How is it going downtown?
It's going great. Nice down
It,
here.
it looks sunny,
Yes, yes, it is.
but I know it's
It,
an illusion.
it's a trick. You're right. It is cold.
Don't
I
go
know
outside.
if you didn't know where we were, you might think we're in Florida, but definitely not.
Don't go outside.
No.
Okay, quite a bit to cover today. We're gonna start off with interest rates. With markets pricing in a high probability of a US rate cut next week, but Canada is gonna hold steady. How do these diverging monetary policies affect both the equities market and currency movements in the coming months?
That's great. Thanks. I think that's a great place to start off. And I think if we, this is, as I think back through the year, it's been one of the most volatile years from a perspective of how inflation and or interest rates are going to change. On almost every meeting, there's been a question mark around are they going to proceed or not proceed. And to your point, in Canada, it looks pretty low probability of cuts next week. We do have unemployment or employment numbers tomorrow in Canada. It's really the last thing that could sway the outcome. But right now we're looking at no change. And then with the US, it looks like certainty they're going to cut. Really high probability now, I think north of 90%. So, some of that maybe has played into the currency. I think probably a bigger impact on the Canadian dollar at this point has been oil related. So as oil's been moving, Canadian dollar's been moving in tandem. Isn't always the case, but certainly has been most recently. So Canadian dollar up a little bit, US dollar down a little bit. I think en masse, though, the US dollar this year has been quite weak, and there's many reasons around that. You would think with having some of the highest interest rates in the world that they would be a little bit stronger. But you've had that divergence there where you've had a weak US dollar, and that has a lot to do with the tariffs and targets going on in the world, the debt levels in the US, the debt ceiling moving again. So I'd say, though, a long-winded answer to your question is, yeah, that it'll have a bit of an impact, may potentially on currency, but it's mostly priced in now. It would be anything outside of that where we'd see a big move. If US didn't cut and Canada did, obviously you'd get a huge adjustment to the currency there. But generally, right now, I'd say mostly priced in. As for its impact on equity markets, I think at this point, again, very little impact unless there's something outside of what we're currently seeing today. And if it's just a regular, we proceed next week with what's expected. Markets probably continue to trudge along, still digesting data coming in from the government shutdown.
Okay. Speaking of job numbers, recent job numbers show an unexpected decline in US private payrolls. What do these figures suggest for future policy decisions and, the broader economic outlook?
Mhm. Yeah. So I think jobs is one of the biggest things that most companies are going to have to contend with right now, and what the government is going to have to contend with as well. So we've seen AI, whether you like it or not, taking jobs. And so the argument to some extent is, well, demographics are aging anyways, so we need people to do jobs that we don't really need them for. We need like technology to do those jobs because we don't have as many people in the workforce. Is kind of that argument to demographic change. But the to your point around what's the immediate concern is it's going to be a challenging environment for I'd say high quality jobs in the U.S. And broader impact is I think this will more drive central bank policy than it has for some time. So there's been this real focus on inflation over the last 4 years since came in and out of COVID. And so I think we're starting to see the attention turn much more towards jobs, and that'll probably drive policy decisions more than it has for some time. And at least in the US now, we're going to have a new Fed chair next year. And so, you could see that playing a part. But short term, if you get an unexpected rise in unemployment, that has an immediate effect on what the central bank will do.
Okay, on the geopolitical front, the US seems to be defending its stance on Venezuela. What are the potential impacts on Canadian energy fields and commodity prices? And I mean, should investors be watching these developments closely?
I think as Canadians, you should watch it very closely, yes. I think that it's hard to really wrap our head around, at least me outside looking in, all these things that are happening in the world, at least in the last 4 or 5 years. Like the Russia's invasion to Ukraine, the U.S. like the China holding down South China Sea with military action, like flybys from Taiwan, like this type of aggressive military activity that's happening. And now we see Venezuela, and I think most people are following it from the periphery, but they're actually taking military action right now with their sinking ships that apparently are carrying drugs, and with U.S. military. So it's a very aggressive stance that the U.S. is taking in the Caribbean. So this is international waters. They're shooting down drug ships. And they've taken something like, I think maybe 50 attacks in the Caribbean in the last 6 months. So it's concerning from how kinetic it's been, and you don't really read that on the headlines. But what does it mean? Bigger picture is 50 years ago, for whatever reason, the refineries in Texas um, decided that they need heavy crude, and heavy crude comes out of Canada and Venezuela. It comes out of other places as well, but Canada and Venezuela tend to be the biggest exporters, importers for the US from a heavy crude perspective, and they need heavy crude in the production of diesel. So they needed to process and keep their trucks running, keep the consumer machine that the U.S. has going running. And so with the last confrontation that they had in Venezuela, they used to import almost 1 million barrels of heavy crude a day from Venezuela, and now it's something like 220,000 barrels a day. So, and we export or import to the U.S. about 3 million barrels a day. So we by far are the biggest, but Venezuela would be second. And so, I think if they get cut off, and Venezuela doesn't ship to the U.S. is one of the things that you should consider, and that being an option, that probably pumps prices a lot higher short term. So you probably see a spike in oil energy prices in that backdrop. The second one is they take over Venezuela, and they start taking more heavy crude in Venezuela and less from Canada. I mean, I think that's one of the things that President Trump would like. Then the third option, which is I think bantered around probably most from people, is that the U.S. comes to an agreement. We give you this, you give us this. We have some kind of strategic agreement to move forward, and production of Venezuelan oil goes to the U.S. and increases there. Again, negative effect on Canada. So I think it's a very important piece to pay attention to, and it's hard to believe that that is, but it's an important piece that I think we need to think about as Canadians and Canadian energy investors.
Okay.
Sorry,
So
long
now,
answer there.
yes, but then we needed the perspective.
Yeah. Yes.
So we've rolled into the final month of the year. What are your expectations for December and how the year might end for investors?
So far it's been ending sideways, we'll say, sideways to up, with low volatility, and really like it looks like investors are uncomfortable. So that's what it looks like right now. We passed December 1st where quantitative tightening was stopped in the US. So they didn't, the US central bank has a huge amount of bonds on their books. as those bonds have matured, they weren't rolling them over, so they're effectively taking the money and reducing their debt levels. And so that stops. So now anything that matures, they'll roll over. So it'll keep the money supply increasing for the next period of time. So I think that'll be an important piece to watch. But right now it's been quiet, which is a little bit concerning. So I'd say quiet's okay right now as we head into the end of the year. Lots of things to cover, but I still think those key pieces are unemployment and money supply. And so we'd be watching that closely. And yeah, I think a general hope feeling that there's a Santa Claus rally where markets go up into the end of the year. Could be the case, but what tends to happen sometimes as well is when volumes are light and volatility's down, there's a risk that something could crack quickly. But right now, I'd be saying sideways is okay, and we'll continue to watch the numbers.
Okay.
Yeah.
Let's see the charts.
All right. Okay. All right. So we are recording on Thursday, December 4th, around 1 o'clock. So anything that happens between now and next week, we will comment on next Thursday. So, a few slides. First one, let's look at policy rate cuts are mostly behind us. I thought this was a good slide and something to think about, particularly asked off the top, Eva, just around what could potentially happen with the differential here. And as you can see, the Bank of Canada is the red line here. As we started into 2017, we started to increase rates. And then we dropped them in March of 20 when we got into the COVID scare. They went down together. And then we marched up together effectively. And then into the latter part of 2023, we went sideways, excuse me, went on hold before the US, and then it proceeded to cut before the US. And so we've been cutting rates now for some time, so we have a pretty healthy differential between where the US is and where we are now. So with the US cutting and continuing to cut now, we start to see that differential close. So some of that is already priced into the currency differential right now, and so we'd be less concerned about that playing a big negative role on how CAD and US work together. But the one thing that typically happens on the back of this is if we are done cutting at this point, you start to see a flattening of the yield curve. So right now we have a normal steep yield curve where front end is lower than the long end. At this point, historically, over the next 12 to 18 months, you see a flattening of the yield curve, particularly on the 5 and 10 year bond rates, and you'd see somewhere between 30 and 50 basis points, so 0.3 and 0.5% flattening of the 5 and the 10 year. And so that's something to be conscious of, certainly from a perspective of if you have mortgage or credit or anything along those lines, what should you do if that happens, that flattening? Also, if you own bonds in the 5 and 10 year range, if you get a flattening pattern there, that causes your prices to go up materially. So I think it's important to think now, if we are at the end, maybe we have another 25 basis points, which is what National Bank thinks. But we're certainly in the seventh or eighth inning on this current cutting cycle, barring material economic sell-off next year. Market sentiment is not exuberant. So this is the next chart we want to cover. So this is something that we've commented on and something that I care about a lot when I'm thinking about where we are market-wise. So you can look at a lot of different indicators. This is our in-house one, so National Bank's version where we look at many different inputs. And presently right now we sit around a 39. So this is on a scale of 0 to 100. Typically, if you get below 20, 20 or below, that's a heavily oversold. That's typically a buy signal. And then if you get into the higher range of this, 80 and above, that tends to typically, again, be a sell signal, at least from my perspective. If you look at the fear and greed index, CNN does a good one there as well. There's a number of different places that you can look at. And CNN's is quite low as well. They're closer to 16, so heavily concerned. So the market sentiment is tilted towards we'll say pessimism. So as the markets go sideways to a little bit up and you get a negative indicator, that tends to really be a signal where you're a little should be a little bit more comfortable being in the markets at that point. When you get either end of this, oversold or overbought, those are signals that we're either topping or bottoming. But right now we're sitting in this middle range, so it gives me a fair amount of confidence to continue to stay with the current portfolio exposure that we have now. And tax switch. So as we end towards the end of the season, this is something that we talked about last week. We are at the end of tax season. So as we look through portfolios, that's what we've been spending the last month on, just looking at the amount of capital gains exposure people have. And so on an individual basis, we have to look at what do we do at this point? Say you have a $50,000 capital gain for this year. We look through different accounts and say, do we have something that's down? And should we be taking that and switching it to something else? Like, for example, in this case, if you have BCE that's down this year and TELUS is down a little bit further this year, maybe you sell, take your tax loss on BCE and buy TELUS from the perspective of you realize those losses, which will help your tax position, but also it doesn't take you out of the whole exposure of the sector because it's likely to recover next year as it's been sold off pretty hard, both paying good dividends. TELUS looks like maybe they won't cut their dividend. It gives you a chance to make a tax effective switch from one company to another company, similar exposure, but overall help the amount of tax that you're going to pay this year. If you're happy with that positioning, this makes a lot of sense. After 30 days, if you want to switch back from TELUS to BC, you can do that without negatively affecting your tax exposure as well. So it makes a lot of sense to be thinking about this. If your advisor's not doing that, certainly happy to chat about that at any point. But this is something as our natural course of business. Review current capital gains. Should we reduce by making some tactical switches? I think it makes a lot of sense to consider that in your portfolio at the end of this year, particularly because the markets have done quite well this year. As always, the opinions expressed in here do not necessarily reflect those of National Bank Financial. If you have any questions for myself or Eva, please reach out to us. If you want to speak to your advisor as well, please do that. Everyone's risk tolerance and situations are different. I'm not a tax consultant, so if you want to have a specific tax question, talk to an accountant. But as always, I appreciate you looking at the charts today.
Thank you, Ben.
Problem.
So what are we looking forward to next week?
Yeah, so next week is central bank fun. So we will have on Wednesday next week, we'll have the two central banks meeting. And so as always, the Bank of Canada releases their results in the morning and the Federal Reserve in the afternoon. Federal Reserve always has a press conference at 2:30. So we'll be watching for any hints of any change in direction out of that meeting. But I'd say that would be the key event of the week from an economic perspective. If you look at the US-Canada economic calendar, Canada is quite quiet. US always has a ton of data coming out, and they're still catching up from the government shutdown. So we'd be watching that. Most of the earnings have come out of all the Canadian and US companies, so there'll be a few more still dribbling in along the way. Canadian banks had results this week, so that was interesting to review. But next week, a little bit quieter with most of that focus around economic changes.
Okay. Was there anything worth noting with the Canadian banks?
I'd say the thing noting with the Canadian banks is they have reduced a lot of their exposure to Canadian real estate, Canadian residential real estate. So they've sold off a lot of their mortgage exposure, and a lot of the current mortgage exposure they have is CMHC guaranteed. Where they made most of their money in the last quarter was, we'll say, capital markets. And capital markets is kind of that trading arm, we'll say. So some bought deals, new issues. All the Canadian banks offer these notes now, accelerator notes and principal protected notes, and those tend to be a big engine driver of the earnings for the Canadian banks. So I think it's something to be conscious of, as I think it's a good driver now, but I also think it's a potential future liability. But right now, it's that's where they've had some significant positive numbers. The other piece is National Bank has participated and they're looking to purchase some of larger banks' assets. So that's an interesting piece. They'll have to digest it and go through that.
Okay. Thank you. Thank you, everyone. Remember to visit, subscribe, and follow us on YouTube and LinkedIn at Hart Investment Group. The link to our daily financial heartbeats will be in the caption of this video, as well as in your email box. For our clients, please reach out to me if you have any questions or if you'd like to book a review meeting with Ben. Thank you, everyone, for listening, and have a good weekend. Bye.
Thanks, everybody. Bye.